When do I pay depreciation recapture tax? Have you ever wondered what happens to the tax benefits you received from depreciation when you sell your investment property? Let's break it down. Depreciation recapture tax comes into play when you sell a rental property for more than its adjusted cost basis. This tax is the Internal Revenue Service's way of recapturing the benefits you received from depreciation deductions during your ownership. First, let's talk about depreciation. When you own a rental property, you can deduct depreciation on the building, not the land, over 27.5 years for residential properties. This deduction lowers your taxable income each year, giving you a nice tax break. Now, what is adjusted cost basis? Your original cost basis is the purchase price plus any improvements you made, minus the land value. Each time you claim depreciation, it reduces this cost basis. So, if you bought a property for $550,000 and claimed $100,000 in depreciation, your adjusted basis would be $350,000. When you decide to sell the property, you calculate your gain by subtracting that adjusted cost basis from the sale price. If you sell the property for $800,000, your total gain would be $450,000. This gain is what you need to consider for taxes. Here's where depreciation recapture tax kicks in. The portion of your gain that equals the total depreciation you claimed is subject to this tax. This means that in our example, the $200,000 you claimed in depreciation will be taxed at a maximum rate of 25%. This rate is higher than the long-term capital gains tax rates but generally lower than ordinary income tax rates. You will pay this tax in the year you sell the property. It gets reported on Internal Revenue Service Form 4797 and included in your income tax return for that year. In addition to the depreciation recapture tax, any remaining gain beyond the depreciation amount is taxed at long-term capital gains rates, which can be 0%, 15%, or 20%, depending on your tax bracket. Plus, you might also owe a 3.8% net investment income tax on the entire gain. To illustrate, let's say you sold that rental property for $100,000 and your adjusted basis was $350,000. Your gain is $450,000. Out of that, $200,000 is subject to depreciation recapture, tax at up to 25%, while the remaining $250,000 is taxed at the long-term capital gains rate. So, to sum it up, you pay depreciation recapture tax when you sell a rental property for more than your adjusted basis, and this tax applies to the amount of gain equal to the depreciation you claimed. Understanding this tax is essential for real estate investors, as it impacts the profit you take home after the sale.